Hello and welcome to a discussion that provides an overview of bonds payable. Bonds payable is a borrowing from investors. Watching this video will help prepare you for class. It is important that you view this before class so we can learn more together in class. After viewing this video, you will be able to locate line items related to bonds on the financial statements and understand the key terms associated with bonds payable. Understanding the terms is very important to being able to account for bonds payable. Take a moment to read through the related terms. A bond payable is simply a company or any other government entity borrowing from an investor. Interest is incurred by the borrower and interest is earned by the investor. Cash is paid and received for interest over the time the funds are borrowed. The amount borrowed is repaid in one payment at the end of the borrowing. Here is the balance sheet for J.C. Penney. Take a moment to locate the bonds payable on the balance sheet. Bonds payable is often reported as long-term debt or notes payable. These words are used interchangeably. J.C. Penney reports current long-term debt and non-current long-term debt. Interest payable is included in accrued expenses. Here is the income statement for J.C. Penney. Interest expenses incurred on bonds payable. Take a moment and see if you can locate the line item that includes interest expense. Interest expense is reported net of interest income on this income statement. Here's the cash flow for J.C. Penney. Bonds payable is a long-term liability and related transactions are reported in the financing activities section. Take a moment and locate the line items associated with long-term debt and bonds payable. The cash flow statement reports cash related to borrowing and repaying long-term debt. The following terms must be understood in order to account for bonds payable. The maturity value is the amount that must be repaid on the maturity date. The maturity date is the date that the total principal is repaid. Periodic interest payments are paid for interest only and do not repay the principal amount borrowed. Both the maturity value and the maturity date are stated in the bond contract. The bond contract states an interest rate for cash paid for interest. This is referred to as the stated rate. The stated rate does not change. The dollar amount of interest paid is computed as the maturity value multiplied by the stated annual rate divided by the number of payments made each year. Payment dates are stated in the bond contract. The market rate is not stated in the bond contract. It is the rate that an investor who loans the money earns over the life of the bond payable. The market rate is set for the borrower and the investor at the time the funds are borrowed. The market rate and the stated rate are often different rates because the market rate fluctuates daily with changes in the economy and risk. There is often a time delay between when the bond contract is established and when the money is actually exchanged between the borrower and the investor. The market rate is determined by the amount of funds exchanged between the borrower and the investor. Let's look at an example of how the amount exchanged determines the rate. This bond has a maturity value of $1,000 and a 10% stated rate. The interest paid will be $100 regardless of the amount exchanged because the 10% is stated in the bond contract. The maturity value is stated in the bond contract also and does not change. The amount actually earned and incurred is computed as the cash received for the interest divided by the amount of cash exchanged between the borrower and the investor. When the investor loans $1,000, they actually earn 10%. They receive $100 each year on their $1,000 investment. When the investor loans $900, they actually earn 11.1%. They receive the same $100 because it's stated in the bond contract, divided by the $900 of their original investment. When the investor loans $1,100, they actually earn 9.1%. They still receive the same $100, they have just invested a higher amount and earn a lower return. The market rate is the rate the investor actually earns and the borrower actually incurs. The market determines the acceptable interest rate investors are willing to earn and prices the bond accordingly. The bond price is the cash actually received by the borrower when the loan is made by the investor. The market rate depends on company-specific risk and overall economic risk. As these risks change, the market rate varies also. The stated rate is in the bond contract and does not change. Bonds have two different interest rates. The market rate is the rate actually earned and incurred. The stated rate is the amount of cash paid by the borrower for interest. When the stated rate is different from the market rate, the amount of cash exchanged will be different from the maturity value. A bond is said to be issued at a discount if the amount of cash exchanged is less than the maturity value. A bond is said to be issued at a premium if the amount of cash exchanged is more than the maturity value. The maturity value is always repaid at the end of the bond on the maturity date, regardless of the amount of cash exchanged. There are a few things that are very important to remember when accounting for bonds. First, bonds have two different interest rates. One is the stated, which is the cash paid, and the other is the effective, which is what is earned and incurred. Second, the amount of cash received by the company is not equal to the maturity value that must be paid back when the two interest rates are different. And third, the maturity value, the maturity date, and the stated rate is in the bond contract, and these do not change. After viewing this video, you should be able to locate the items on the financial statements related to bonds. You should also be able to define the terms associated with the bond, such as the maturity value and the maturity date, the stated rate and the effective rate, and when a discount or premium occurs. This concludes our overview of bonds payable. In the next video, we will discuss how bonds are accounted for and reported. Please fill in the blanks on the bonds payable pages in your course pack and work through the self-test and the practices you learn on StudyMyAccounting.com. Thank you for taking the time to be prepared for class. It is very much appreciated.